Do you know about the upcoming tax changes for 2025 that will directly affect your wallets? Most Canadians are paying a lot of taxes every year, missing out on lots of potential tax savings. After going through the 2,000-word publication by the CRA, I've compiled the 10 important things you need to know about the tax changes in 2025. Number 1 is the tax brackets. In Canada, we have a progressive tax system with marginal tax rates. Basically, the higher income you earn, the higher your tax rate will be. But the higher tax rate doesn't apply to your entire income. I've explained how it all works in a previous video, so I'll leave the link in here or in the description below so you can check it out if you don't know about this already. For 2025, the tax rates remain the same, but each of the federal tax brackets have increased by 2.7%. And this is determined by the inflation numbers. So this does mean that our inflation numbers are finally looking better compared to the previous 2 years. What this means to Canadians is that more of your income is going to be within the lower tax brackets. So you end up paying less taxes if your income is the same as 2024. Each province also has their own tax brackets and their own tax rates. And they also adjust the tax brackets this year based on the inflation numbers. For example, BC and Ontario increased their tax brackets by 2.8%. And Alberta increased their tax brackets by 2.7%. So how much income tax do you save then, assuming you had the same income as last year? For someone with an income of $80,000 in BC, let's first take a look at how much tax they would pay in 2024. The first $47,000 of income will be in the 20% tax bracket. So this would mean a tax amount of $9,616. The next $7,930 of income would be in the 22.7% tax bracket. And this would lead to $1,800 of taxes. Then the remaining $24,132 of income would be in the 28.2% tax bracket. So this would mean a tax of $6,805. So in total, you would be paying a total of $18,221 before any tax credits or deductions. Now let's compare that to 2025 with the increased tax brackets. For 2025, the first bracket has now increased to $49,000. So that means for the first $49,000 of income, it will all be within the 20% tax bracket. So this would mean $9,885 in taxes. The next $8,095 of income would be in the 22.7% tax bracket. And this would mean $1,837 in taxes. Finally, the remaining $22,624 would be in the 28.2% tax bracket, which means $6,379 in taxes. So in total, our taxes would be $18,102 before tax credits and deductions. That's a difference of $118, assuming you had the same income of $80,000 in BC. But the amounts I mentioned here was before we take into account the tax credits. So next, let's talk about what are the changes to the tax credits this year. For 2025, CRA has adjusted the amounts to the basic personal amount, the medical expense tax credit, and the age amount for retirees, among other things. For the federal basic personal amount, it is now $16,129 compared to $15,705 in 2024. However, when your income is above $177,000, your basic personal amount will be reduced to a minimum credit of $14,538. Depending on how much income you are above the threshold. Each province also has their own basic personal amounts to help Canadians reduce taxes. The actual tax dollar you save from the tax credits is calculated by using the lowest tax rates. For example, with the federal basic personal amount, the lowest federal tax rate is 15%. So this means when you have a maximum amount of $16,129 of basic personal amount, you get to reduce your taxes by $2,419. Next is the medical expense threshold. For 2025, the medical expense threshold for claiming a tax credit is $2,834. This means that if your total medical expense is over 3% of your net income, or $2,834, whichever is less, then you'll get a medical expense tax credit that can help you reduce your taxes. There's over 100 eligible expenses that you can potentially claim for your medical expenses. So if you're not sure, then you should check the CRA website to see if you can claim the medical tax credit. and I'll leave the link in the description below. Then there's the age amount. This is a tax credit for retirees over age 65. And for 2025, the tax credit they get for this age amount is $9,028. This was increased from $8,790 in 2024. Again, the actual tax dollar that you save from these tax credits, we need to calculate that using the lowest tax rates. So for example, for a retiree in BC, the tax savings they get from the age amount is $1,811. This amount starts to get reduced or claw back when your net income exceeds $45,000. And it will actually be reduced to zero when your income is over $106,000. This is one of the reasons why retirement tax planning is so important. Because if your income is too high from pensions or RSP or RIF withdrawals, then you may lose out on some tax savings or even get reduced government benefits. My colleague Jacky has made an excellent video on the top 5 retirement mistakes Canadians make. If you're near or already in retirement, you should definitely take a look, and I'll leave a link in the description below. The third important thing to know is payroll deductions. If you ever looked at your pay stub, you probably noticed that there are a couple amounts that are taken away from your paycheck. Among other things, there are the income tax withheld, as well as contributions to CPP, or the Canada Pension Plan, and the premiums for EI or employment insurance. For CPP, the contribution rate remains the same for 2025, but the yearly maximum pensionable earnings, which is the amount that determines the maximum amount of CPP contribution someone can make within a year, has been adjusted to $71,300 compared to $68,500 in 2024. The basic exemption amount is still $3,500, but one important change to be aware of for 2025 is the CPP enhancement. The CPP enhancement affects Canadians with an income of over $71,000. And if your income is over $81K, then you would be paying the maximum amount of CPP contributions. For the first tier of CPP contributions, the contribution would be $4,034. Now for the second tier, they've increased it to $81,200, which means a contribution of $396. So in total, the maximum CPP in 2025 is $4,430. As a quick comparison, here's the maximum contribution you could make to CPP across the 3 years. But if you do any freelance work or if you run a self-employed business, then the income is subject to double the CPP contribution. So the maximum would be $8,860 instead. Another deduction from your paycheck would be the EI or employment insurance. The premium rate has actually been lowered to 1.64% compared to 1.66% last year. But that's a very small difference of only $12 for someone making $60K of income. The maximum annual premium has increased to $1,077, which is up from $1,049 in 2024. You would need to pay for this maximum premium when your income is over $65,700. Now the good news is they also increased the EI benefits that you could receive. For 2025, the maximum benefit you could receive is $695 per week compared to $668 per week in 2024. But if you're a self-employed individual, then you won't be paying into EI automatically. This is because the EI program for self-employed is optional, and you'll actually need to register for it yourself if you want to be enrolled in it. This program does provide the sickness and the maternity benefits like the regular program, but it does not include unemployment benefits like the regular program does. For more details, I'll leave the link in the description below so you can check it out as well. Now that you know what's being taken away from your paycheck, now let's talk about what can help you put more tax dollars back into your pockets, and that is the register accounts. First is the TFSA or the tax-free savings account. For 2025, the contribution room has increased by another $7,000. And if you've made any withdrawals in 2024, then you also gain that contribution room back, and the amount is equal to the amount that you withdraw out from your TFSA. And for any unused contribution room, it will be automatically saved for you so you can use it in the future. The maximum room now is $102,000 if you've been a resident of Canada since 2009 and you're 34 years or older. This is because you start accumulating contribution room when you're a resident of Canada and you're over 18 years old and you have a valid SIN number. So depending on which year you turn 18, here's a table to see how much contribution room you would have, assuming you've never made any contributions. As for new immigrants, this is the table that you can refer to see how much contribution you would have, depending on which year you've immigrated here. The next registered account you must know is the RRSP, or the Registered Retirement Savings Plan. Unlike the TFSA, your RSP contribution room is not based on a flat amount. Rather, it's based on 18% of your last year's employment income. This means that everyone has a different RSP contribution room, and you can check how much room you have on the notice of assessment that you receive after filing your taxes, or by checking your MyCRA account. For 2025, the maximum contribution limit has now increased to $32,490, and that is up from $31,560 in 2024. This change only affects people with an income of over 180K of income. One note here is if you have a pension plan with your employer, then there will be a pension adjustment that will reduce your RSP contribution limit. Another thing that might be confusing about the RSPs is that the contribution period for each tax year is not January 1st to December 31st. Instead, the contribution period is actually from March 1st to the end of February of the next year. This allows you to have the first 60 days of each year to tally up your income so you can decide how much RSP you want to buy to lower your taxes. Another thing to know is that the RSP Home Buyers Plan is one way that Canadians can withdraw from their RSPs tax-free for the purchase of their first home. And one big change that has happened here is that the maximum withdrawal amount is now bumped to $60,000 instead of the $35,000 from before. And the repayment doesn't start until the 5th year after your withdrawal. This is going to be extremely helpful for people who are looking to buy their first home because you can now increase your down payment and also have more time to get used to your mortgage and your housing costs before you need to worry about the repayment. Couples who are buying a property together can both use their home buyer's plan to double the withdrawal amount for their down payment. Also, withdrawing under the home buyer's plan does not affect your FHSA withdrawal, which is the next registered account that we'll talk about. The FHSA, or the First Home Savings Account, is the new account that is purely for first-time home buyers. You can get a contribution room of $8,000 per year as long as you have an FHSA account open with any financial institution. What's good about this plan is that when you make a contribution into this account, you get a tax deduction to help you get additional tax savings. And when it's time to buy your first home, you can withdraw any amount out of this account tax-free. And you can also use it together with your RSP Home Buyers Plan to really enhance your down payment. And the best part is that no repayment is required for this account. And for any unused contribution room, you can carry forward a maximum of $8,000. This means that the maximum contribution you can make in any given year is $16,000. Even if you've had an account open for a couple years and haven't used up the room. Next, let's go over the key deadlines for 2025. The deadline to contribute to your RSPs for the tax year of 2024 is March 1st, 2025. For personal tax returns for individuals, the deadline is April 30th. And for people who are self-employed, the deadline will be June 15th. Well, one thing to be careful here is even if you're self-employed, your tax payment deadline is still April 30th. This means that you should still prepay the tax that you expect to owe before the April 30th deadline. For the prescribed loan payments, the deadline is January 30th of each year. And for corporate tax returns with a year end of December 31st, the deadline is going to be June 30th. And finally, the earliest date to file your tax return is February 17th. But what I usually tell clients is that they should wait until at least mid-March before filing their tax returns, unless they're certain that they have all the relevant tax slips. This is because banks and financial institutions will issue tax slips for any interest income, dividends, or capital gains, and these tax slips may not arrive until sometime in March. So if you went ahead and filed early but realized that you missed some slips, then you may need to do a T1 adjustment to add the missing tax slips back, which would cost you extra time and money. Next is the capital gains tax change. With your investments capital gains, it used to be at a 50% inclusion rate. This means whatever profit that you made from your investment sale, 50% of it will be included in your taxable income and be taxed at your highest marginal tax rate. But for 2025, the capital gains tax has a huge change, where you would still pay 50% of inclusion rate up to 250K of capital gains. But if you have capital gains of over 250K, then the inclusion rate jumps up to 67%. This change doesn't affect most Canadians, since the principal residence is tax exempt, but it does affect those who have an investment property and are looking to sell their property for a profit of over 250K. Also, for business owners with corporations, it's even worse because now all the capital gains that they earn will now be taxed at a 67% inclusion rate. However, this tax change has not become the law yet, so it's still subject to legislative changes. On the bright side, small businesses will now see a higher lifetime capital gains exemption. The lifetime exemption has now increased to $1.25 million for small businesses to sell their company tax-free, whereas for 2024, it used to be $1.01 million. Next is something that retirees would care about, and that has to do with old age security. This government benefit provides retirement income for Canadians depending on how long they've lived in Canada. But the amount you get can also be reduced if your total income is too high during your retirement years. The clawback threshold for 2025 is now $93,000, which is up from $91,000 from 2024. This is really just a 2.7% inflation adjustment. Next is something that parents should care about, and that is the Canada Child Benefit. This is a government benefit for parents, and the amount you're eligible for depends on your total household income. For 2025, you can receive a maximum benefit of $666 per month per child under age 6. And for children who's age 6 to 17, you can receive a maximum benefit of $562 per month per child. To get the maximum childcare benefit amount, you need to have less than 36K of family adjusted net income. Next is prescribed rates. For higher income families looking to reduce their taxes by using family loans and splitting income to someone with a lower income, you should know the prescribed rates are finally coming down. For 2025, the rate for family or shareholder loans is now at 4% for the first quarter of 2025, compared to 5 to 6% for the year of 2024. Also, for people who owe taxes to the CRA, the interest rate is now at 8% for the first quarter of 2025, as opposed to 9 to 10% in 2024. As mentioned earlier in the key deadlines, the annual interest payments must be paid by January 30th. Otherwise, the income will be attributed back to the higher income individual. And that leads me to something that you need to realize. And that is there are actually lots of opportunities for you to pay less tax. But it's up to you to discover them and figure out which one can apply in your specific situation. Click here to learn the top 6 things to legally pay less tax in Canada.